Okay, so welcome back to part three. This is where I'm just going to go through a macro outlook. Again, always remember this is just sort of how I see things. It doesn't mean that it's what everybody's going to see, or not everyone's going to agree with me, because that's just natural. Uh, no one likes to agree with me. No, I'm joking. But when it comes to sort of economics, everyone's got different ideas. You even see that with the central bankers, so it's not a surprise. But of course, that's what makes the markets work as well. Okay, so let's take a little look and see what my expectations are for the macro. Okay, so the market's focused more on data than sort of these geopolitical conflicts that are still going on. And for me, that's a good thing. Obviously, it'd be nice if there wasn't any conflict, but that's just the world we live in at the moment. Now, stocks rallied last week, and that's because the markets believe that the Fed are done hiking rates. Thursday there was that big spike everywhere except for the dollar, just on that sort of CPI data, with expectations that the Fed have probably done enough now. But yeah, so we're still seeing that feed into the economy, all those rate hikes. But you know, you can't write off the opportunity for another one just yet. Okay, so peaking is one thing. Cutting is a very different thing. And there's so many people that are starting to talk about, when are the rate cuts coming in 2024? They're going to be early in the year, blah 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 blah. I'm just not so sure. As I sort of keep saying, I think they're higher for longer. Even the central banks are saying that, especially the Fed. And it's not just a phrase that's being used. It's a fact. A lot of people have got used to cheap money, but that's for the extremes. That's for when there's a crisis. So we should get used to higher rates. And as I keep writing, central banks need to see inflation probably at that sort of target level of 2% for probably 3 to 6 months, just to satisfy themselves that they've won that battle. Whether it is them or not is another matter, because cutting rates, I just don't see it for the moment. Well, when you look at the Fed, the ECB and the Bank of England, there are possibilities that they'll probably start to cut around about mid 2024. More likely for the ECB and the BOE, I reckon, because they might just panic sort of thing, trying to prevent any further downturn if it starts to feed in from all these rate hikes and potential build up of job losses, etc., etc. So they might just want to keep their economies from going into a full-blown recession. Now, I expect probably that all that sort of build up and deluge of rate hikes that we've had have probably fed into the economy probably around about by the end of February. That's when I expect the final impact to be. Again, this is only my view. And then for me, the main reason that the US economy has remained stronger than sort of its peers, for me, the only reason, or mainly the only reason, is the fact that they added so much stimulus over COVID. Now, although the rate hikes have impacted disposable income, because obviously people are having to refinance and finance their loans, etc. And of course they're paying a lot more for that. And that has chipped away at demand. But personally, I still believe it's price of products themselves that's been the main deterrent for shoppers. They've become more cautious, more selective, starting to look for those bargains. And then the question comes, are corporations going to be prepared to start to reduce their profit margins or are they happy to sell less for more? But when we look at those unemployment numbers, yeah, they are creeping up higher, but very, very slowly. You know, I would have expected them to be moving at a faster pace by now. But I do expect that to happen in 2024. You know, there's going to be sort of more workers. Yeah, okay, so, you know, when you look at it, I mean, demand for workers has been so high. There's been such a shortage around this year, and then of course that's been good because workers have managed to get good pay rises because of that. I mean, just look at the auto workers in the US. But those sort of more people working doesn't always, in my mind, equate to more demand. Because a lot of those coming in are sort of maybe the young lads just left uni and stuff like that. And of course, they've got a lot of loans which they've had to start repaying again now. So I'm not sure that that really builds up for the demand side. However, I think when there's fewer workers, that certainly does lead to lower demand. So if we look at sort of what happened in the markets last week, so oil, WTI, sort of, it rallied Friday. You know, it was just over $72, but it finished back almost around 76. And lower oil is really good for inflation, I would say, you know, transport for us as well. Now, obviously, it's not so good for OPEC Plus members. Which leads me to sort of come up with a question: will they dare cut supply again before the end of the year? Now, the dollar's sort of really been driven by data, but I've got to say, I do think traders are being just a little bit short-sighted with the dollar. You know, they're sort of selling the dollar just because the Fed will not put rates up again. Well, you know, they've already put rates up more aggressively than pretty much most of the other countries. So, and of course, you know, if they're not putting rates up because inflation's coming down, then surely that's a good thing. That's a benefit for the economy. You know, there are a few areas of concern for the US. For me, the real ones are the political situation, and the other one really is obviously debt levels, especially government ones. So jobless claims was higher than forecast, not by much, but a little bit. And again, as I mentioned before, I do see that picking up next year, and not just in the US, but I think that's going to be probably pretty much a global situation, where you know, the unemployment rates will start to creep up. As I just mentioned, debt levels will become a major concern, especially as, you know, many of these sort of low fixed loans that have been out there expire, and that's going to happen probably over the next 18 months. And of course, they're going to be replaced at double, if not treble, the rate that, you know, the borrowers were actually getting initially. Now, that could lead to some distressed sellers. However, you know, especially if it's around a mortgage, I would probably expect the banks are going to offer to extend those mortgages, the term of those mortgages, to help people to sort of keep those repayments going to be higher, but just to keep them as low as possible. And of course, it's good for the banks because they're going to get that interest for years to come. An interesting fact, though, is that if you look, this is specific for the US, mortgage-free Americans is at an all-time high of 40%. So I thought that was quite interesting. Okay, so let's have a look at next week. So the highlight next week will be the FOMC minutes, plus a few central bankers speaking, as they love to, and some PMI data. Now, the rest of it is probably going to just be sort of any changes that come along in the geopolitical situations that we're seeing between Israel and Hamas. And of course, you know, that's sort of really pushed Russia, Ukraine into the shadows at the moment. And of course, now we're getting closer to that winter period. Is there going to be a pause in that war, or is it sort of going to be a last salvo before winter sets in? The Biden Xi Jinping meeting didn't really produce any major breakthroughs as far as I can see. And personally, I think China probably needs something more than America. The American economy is still really nice and steady, which is not something you can say about the Chinese economy at the moment. Too much local debt, and of course those real estate pressures are there as well. It just doesn't, even though the government's trying hard, they just don't seem to have found the right solution at the moment. Now, okay, so Musk, very controversial at the best of times. Sometimes I think a little bit like Trump, but with Musk here, so yeah, he's the richest man on the planet, which is probably just as well. Because some of his actions and comments, they just are hard to believe. So his recent actions are now seeing advertisers pull or suspend their promotions on his X platform. Even just renaming that to X, I think, has cost him a lot of users and revenue anyway. But now, I'm a little bit concerned because that could sort of even go a step further and not just all about that, but it could actually impact Tesla as well, Tesla stock. I believe that there's some shareholders calling for his suspension of CEO even. So that's interesting, I think. So Israel is considering expanding its military offensive. By that I mean that they're considering extending it into the south of the territory, and of course they pushed everybody into the south, so I'm not sure how that's really going to work. What we don't want to see is an escalation of civilian casualties for sure. But I guess they consider that a lot of the Hamas may have used the opportunity of allowing everyone to move south to go with them. And then probably their plan was to wait and fight another day. And of course, if Israel does decide to do that, they're going to be fighting a bit sooner than they probably expected. Now, we're only in the middle of November, but I do like to sort of look ahead, and I'm now considering what 2024 can bring. When we start to look at that, so what are going to be the market impactors? Now, I haven't got any details at the moment because I'm still thinking about it all, but just to sort of highlight some of the things that I'm going to be analysing is obviously the geopolitical issues that we've got, wars, but also next year, sort of around this time next year, or just slightly earlier in a matter of days or a couple of weeks, is the US next election. So that's going to be a lot of posturing. Obviously Biden's not going to want to see the stock market crash or anything like that. And again, does that mean that not so much that he can pressure Powell into cutting rates, but maybe he would like to see them a little bit lower, obviously, but I think it's probably more important for him to see inflation back under control, because that obviously wasn't going too well. He was sort of, look at me, look how well I've done with the economy, and everyone sort of responding going, yeah, but look how much extra we're paying for goods. And then of course central bankers, the focus is still going to remain on interest rates. Will they, won't they? Up until now it's been, will they increase them again? Next year it's going to be, will they decrease them? Will they start to cut or not? And you've already heard my view on that. Something else I'm going to really keep an eye on are debt levels, sort of household debt, corporate debt, even government debt. And then jobs data, wages, there are other areas I'm going to be interested in. For FX, the big question is, will the dollar strength continue? Can it continue? For me, it should, just because they've got the best economy. but not all traders think like that. Everyone's looking at rates more than the actual macro outlook, which I think is a little bit short-sighted. And of course, as all of these final hikes do feed in, is that going to increase the recession risks? What's going to happen with China next year? If spending continues to drop, that's going to impact the Chinese economy, both domestically and from an international, because they're going to be exporting less. And of course, what that overall supply and demand is going to be like. Probably one of the biggest questions but next year is who's going to blink first. So when it comes to the interest rates, who will cut first, ECB, Bank of England, or the Fed? Now, as I say, I'm going to go deeper into all this, but probably a little bit more towards the end of the year, because I want to do a lot of thinking and sort of research first, and make some of these assessments. I might even look at what, the impact it's going to have on some of the stock sectors. And again, so if you trade or invest, where's the best gains going to be next year in 2024? So yeah, I always like to sort of try and think as far ahead as possible, but sort of not overstep it where, because your view today can even change, well, same day or in a couple of days. So it's not always as clear cut as we think it's going to be. You can see everything that's happened over the last couple of years that's decided that as well. All right then, so that's my macro. We're now going to take a look at some charts on a variety of different asset classes. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. Apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So that's I'm not saying I'm going to turn you into a massive trader in 20 sessions, but getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. Maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4. As usual, we start with our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, although hopefully it is for you. When it comes to leverage, just be careful because you can lose substantially more than that initial investment. Everything we include in here is just purely for educational purposes. We're not trying to provide you with advice. We're just trying to help you prepare, understand the markets better, to help you make better decisions. But of course, if you are looking to invest or trade, that has to be your decision. And before you make that, you should consider your financial situation, your level of experience, and your risk appetite. And of course, on your risk capital, you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before risking your capital.